everyone, this is Abhijit Chatterjee and Rohan Singh recording our Charts are Fun weekly session for the week of October 21st. Today, after the market close on October 25th, market continues to hold strong. The bears were hoping that there would be a seasonal correction, as typically is seen in September, October, in particular being an election year, presidential election year. There was expected volatility. So far, market has fooled investors, looking for that pullback. It's been holding strong. Yes, we get some bit of a pullback in small caps this week. IWM in particular from somewhere near 227 pullback to 218. Small S&P pullback slightly, not that much, still holding near its highs, closer to 5,900. And we know that there's a target on S&P. We've talked about it, just a little over 6,200. Will we just get there in the next couple of weeks? We know the election is only, 7 trading days away. Next week is huge week for big tech earnings. We're talking about one of the Magnificent Seven announced earnings this week, which was Tesla. They blew away earnings numbers. The stock absolutely shot up 25% on a very large cap stock. That was just absolutely amazing. We'll talk more about it. But big tech earnings next week. We're talking about Google, Amazon, Apple. All these are up to the medal announcing earnings. IBM was a bit of a disappointment this week. Their earnings was on Wednesday, and the same afternoon as when Tesla announced, and IBM got hit hard. Not hard as in from near above 230s, it fell towards the 210 level. So we got a bit of a 10% correction there. So what are we going to look at today? We will look at the key market indicators, momentum indicators, complacency, and call it, put call ratio. So we look at the oscillator. We'll look at the put call ratio. We will also look at the 10-year yield. It's important because it's a barometer for the market. In particular, we know small caps are directly following the 10-year yield. So is the housing stocks. The fact that the 10-year yield rose up quite a bit since the September 18th Fed decision has not been so good for small caps, which are yet to break out to all-time highs. In fact, is yet to break out above the 2021 high. So we can look at that. We look at S&P and small caps. We look at one sector that has really lagged this entire year, in spite of all the geopolitical uncertainty, especially in the Middle East, where we know that oil prices are directly impacted by crisis in the Middle East. So far, crude, West Texas crude has been hovering below $80, anywhere from the low 70s to mid 70s. So we look at XLE, the ETF for energy, and then talk about the big, news stock of this week, Tesla. See what Dan Ives had to say, see what the chart looks like in terms of further upside. And then a correlated stock, which has become more correlated because of Texas plans for the robotaxi, is Uber. Uber took a hit after Tesla's earnings, partly because Musk seems confident about the robotaxi launch by 2026 timeframe. So we look at where Uber could be headed. It did take a hit after Tesla's earnings. And then Bitcoin, we know that that's been speculative stock, has had quite a wide range movement, but we look at its pattern, and in particular, it seems like it's a presidential trade. Former President Trump seems to a big fan of Bitcoin, and we'll see where that could be headed, based on the election outcome. And then one stock that I had blogged about, it's a company that was one of the pioneers of Wi-Fi or wireless speakers. Back in 2002, out of Santa Barbara, companies called Sonos, they really pioneered this technology so that you could basically put up speakers in every room of your house without having to snake wires everywhere. And that technology has been around. It's around the top 8 or 9 best-known speakers out there, even beats Bose in the recent ratings, but it took a hit. They launched their app update, and their app turned out to be a disaster, a total fiasco. It came out in May. It didn't quite work. Many of these settings weren't working. The loyal base of 5 million plus folks who use Sonos were very upset. The CEO didn't quite take responsibility to turn it around fast. It's been a bit on a struggle path, but that company had bought a Dutch innovative speaker maker back in 2022. They just launched a brand new speaker that's supposed to be a sound bar that you attach as an entertainment system with your large screen televisions. That's got some amazing technology. It's basically sound in motion technology that's supposed to give you magnanimous sound, realistic sound when you're watching at animated videos and so on, with the smallest form factor ever. So that's a piece of technology that the could turn around the company. It's just been launched, going to start selling in late October, early November. And we'll see their earnings are coming up as well on like second week of November and see what they say about their future prospects. So with that, let's just share charts and look at where the market is headed. Start with our blog site. This is chartsaretfun.substack.com. We appreciate you subscribing to it. Just share your email. You'll get blogs from us every morning when it comes out. Usually it tries to come out at 7 a.m. If it doesn't, for some reason, sometime in the day, the blog will come out. So we publish blogs every day, Monday to Friday. And on Saturday, we just have a special on chart patterns. That's following from Helene Meisler, someone who I really adore and admire. Following from her, put out a chart pattern kind of a blog on Saturdays. Our YouTube site is also Charts for Fun, is a channel at Charts for Fun. Appreciate you subscribing to our channel and also hitting the like button on our videos. We really appreciate that. So let's talk about the volatility, which is VIX, and see, I had talked about it last week. I had said that potentially we could be looking for a volatility spike, either right before the election or in the next few days or a couple of weeks. Well, let's see. We know that we got this huge spike of VIX to 65. That was a very unsettling situation with the Japanese carried trade, yen carried trade situation, and there was an unsettling news on the job market from the July data that came out in early August. VIX shot up to 65, and from there, yes, it has very rapidly come down to 14. But one key factor to think about is VIX now is on a much higher range than it was in the earlier part of the year. Before, it was anywhere in the 11 to the 21 range. Ever since that shoot up to 65, now it's settling down more in an upper band from anywhere around the 14 to the 23, 24 level. So 23 touched twice in early September and kind of first part of October. That's a cup. Pull back shallow towards the 18 level. Notice it's been holding and hanging on to the 50-day moving average. So this is a daily chart. The blue is 50-day, the red is the 20-day. So it has been hanging on to the 50-day moving average, somewhere on the 18 level. And potentially this could have a spike break higher. Today, for example, was up 6.5%, closed above 20. Breaks 23, a measured target is from 15 to 23. That's 8 points. At 8 points, 23 is 31. So a spike of VIX to 31 couldn't be ruled out. And that's potentially a possibility either right in the next week to 7 to 10 days or right after the election. We'll have to see where that's headed. Another key pattern we're looking at is the NASDAQ McClellan oscillator. That's an interesting pattern of lower highs and higher lows. In many ways, we call it a symmetric triangle. So draw a line through the peaks and line through the bottoms. That's a pattern that seems to be squeezed out to a point where it's getting close towards an apex, where typically out of these patterns, you get a big breakout higher or lower. In this case, an oscillator shooting up higher means a big market rally. This is an indicator of market breadth. So a big rally across the board could cause that oscillator to shoot up towards the 90 level is on the high side, versus the minus 90 level on the negative side if a massive sell-off happens. This is something to look at. This is something very interesting happening in the market. Another indicator, which is more of a sign of complacency, it's looking at CBOE's equity put call ratio and take the 30-day moving average of that, shown here in the blue zigzag chart. Notice that there is a kind of well-defined range over the last 20 plus years. We have on the upper bound around 0.8, the lower bound is around 0.54. Whenever it's touched that, it spiked higher and then immediately pulled back. But it's, crossed below and then immediately snapped back higher. Snapping back higher from a lower level to higher is typically a market peak. So put call ratio gets high complacency towards the 0.54 point or below. And then shooting higher means the market starts correcting from that peak. On the other hand, when put call ratio goes to a upper end of the above the 0.8, that's basically high fear. That's typically when we get a market sharp correction. So 2023, we had a very sharp rise of the well, first of all, let's look at 2020. That's the COVID sell-off, a very sharp rise of the put call above zero point 0.8, very quickly pulled back. And by early 2021, we know that that's when market was like exuberant all across with all those SPACs, all the huge amounts of liquidity out there. Look at where it went from one end of the pole to the other end of the pole, where complacency, the put call ratio went almost close to the 0.4 level. From there, it shot during the late 2022, October 2023 market bottom. This is when we know late 2022, tech stocks across the board were hit. We had NVDA, we had Meta, everyone reeling, struggling in that end of 2022. Put call ratio hit closer to 0.98. That's just absolutely amazing how much fear was in the market at that point. From there, it has come down towards the July of 23, around the 0.54 level. Another spike back higher towards the October low of 2023 has been steadily coming down since then, of course, in a zigzag pattern, up and down, up and down. But now we're getting close to test that critical 0.54 level. So that's not too far away. We are at that 0.55 is where the 30-day ratio is. We could effectively be there in the next couple of weeks. And that could mean that the market is hitting a complacency extreme from a put call ratio coming down as low as towards the 0.54, and be prepared for a correction. Be prepared for some form of a sell-off in the market. One of the parameters I talked about is the 10-year yield. Look at this 36.03. That's 3.6% in 10-year yield. That's right on October 18th, the day the Fed did the 50 basis point cut. Market signal after the cut was, look, we don't think you really needed that, was market signal. And as a result, from 3.6% on 10-year yield, we went up to 4.26%. That's 66 basis points, right? 0.66 of the move in this 10-year yield. Not something that, the mortgage market, in particular, those buying homes, would have looked forward to. You know that, yes, we had extreme levels of, like when it was last year, beginning part of the year, mortgage rates had even hit as high as 8%. From there, when it was at 3.6, the 10-year yield, mortgage rates, the 30 years had come down closer towards the 6%. Now we are back towards the 7%, towards the 6.8, 6.9% 30-year mortgages. Not something that the housing market likes. Question here is, and this is also something that impacts small caps. We know that they need to raise funds. They're not as cash rich as the large caps. They do need to raise funds every once in a while to run their business. And higher rates are not friendly to small caps. So this, in essence, ever since the 10-year yield has been climbing, has dampened the movement, the bull run in small caps. Now, where could this be headed? Well, if you look at 3.60 to 41.2 and say, well, maybe that's a bit of a small kind of a cup forming, it's a little bit of a shallow handle and then a breakout. 36 to 41 is 5.2. 5.2 added to 41.2 is 46.4. So 46.4, 46.38, we know has been previous resistance. It's possible that that's where 10-year yield is headed. So somewhere around the 4.6 level, 4.6%, is maybe where 10-year yield could head. If that happens, I would think that small caps are not going to like it, nor would the housing stocks. So that's something for us to be cautious about. However, we do know that around the 4.2%, 4.2, 4.3%, it's a major kind of, see, 4.18, 4.18, which is about 4.2 roughly, is major support, which is now resistance. It might just pull back from here. One possibility is money movement into safe haven treasury buying. Possible trigger points were, we were talking about last week, that maybe a geopolitical war. We know that there's the Iran-Israel crisis. There is a potential strike back of Israel onto Iran. And if that happens, treasury markets could get a bid, yields could come down. That's one possibility. The other possibility is this has been a bit of a Trump trade. The fact that 10-year yield rallied this much, market is expecting inflation from a potential Trump win. And in particular, if it's the Republicans having a sweep of both the Congress and Senate, they would be out there cutting taxes. They could be out there in many ways, the tariffs would be back in the picture. And those are inflationary in trend. And the inflationary concerns is what got the 10-year yield moving up so sharply higher. So that's, again, a potential possibility on the outcome on the November 5th night, whatever happens, you could see a 10-year yield outcome from it. Now, what about S&P 500? We had talked about this pattern called a bearish rising wedge. What does a bearish rising wedge do? It means that if you take the tops and you take the lows, they converge to a point where it literally, narrows down to an apex. And from there, either breakdown comes, is in most cases that's why it's called bearish. The wedge pattern then breaks below it and then starts coming lower, which is what happened here. You notice that S&P kind of converged somewhere near the 5,900 apex, didn't quite get to 5,900, got close to 5,878, and then from there has been trending lower. Hasn't trended a lot lower, 120 points from 5,878 to 5,762, and ended closer to the 5,800 today at the end of the week on the 25th. We can see that PPO has begun to kind of cross below. The black line is below the red line. The histogram is below this zero line. And potentially RSI is not able to maintain strength. As this has been climbing, RSI has not been able to recover and regain strength to pull above 70 as we had in the early part of July. So that's something, bit of a negative divergence, bit of a concern. And potentially this could mean that if VIX, as we talked about, does this cup and handle from 15 to 23 and jumps spikes to 31? If this oscillator from its symmetric triangle breaks down towards the minus 80 level, this is the NASDAQ oscillator. If CPCE, having touched the 0.54 spikes higher, CPCE as in the put call ratio spiking higher is usually followed with a market correction. Why? Because more put buying starts happening over the calls, and that gets the ratio up from the 0.54 towards the 0.8 level. Potentially, and the 10-year yield maybe gets a bid. Maybe from 4.2, it starts trickling lower, TLT starts rallying, yields come down, and that could be correlated from a safe haven perspective of money moving out of stocks into bonds or into treasuries. Something for us to look into. Now, what about small caps? Small caps, interesting enough, has a very bullish pattern. Unlike S&P, which is more of a bearish rising wedge, small caps have something called an ascending triangle pattern. The horizontal line at 227 is the resistance level, and the line joining the higher lows is what the ascending part of the pattern is. A breakout here, by the way, is a clear measurement to 258. Why? 196 to 227. That's roughly, we're talking about 31 points. So 31 points plus 227 is 258. That's where IWM, the Russell 2000 ETF, could be headed. We know that it closed right at that rising trend line near the 218 level. We'll see what happens next week. This is clearly watching for a signal from the 10-year yield. If the 10-year yield, for the time being, doesn't go past the 4.2 and starts going lower again, goes below the 4% level, good chance that small caps break higher. But would it be possible that S&P sells off in the small caps rally? Rare. The only factor that many are looking at is what's causing S&P to keep climbing higher rise. It's the Magnificent Seven. Like we saw Tesla, we got NVDA, of course, had recently broken above its key level at 140 and touched 143, 144, pulled back and closed right below 140. Apple earnings coming out next week. Microsoft is there. All the big Mag 7 earnings are coming up, and we'll see how the market reacts to those. In particular, Meta has got a very bullish looking possibility to cross 640 level or somewhere around 640 is its target. Google could break out above 170. All of these are potential possibilities of continued strength in S&P, but we'll find out how the technology earnings next week, what do they do to S&P 500? And maybe the small caps get a bid primarily because of the 10-year yield coming down. Now, one sector, and I talked about this, is energy. The ETF for that, these are the select sector SPDR, the 11 select sector SPDR ETFs. XLB is the basic material to XLY is discretionary, and XLE is energy. This has got a beautiful cup and handle forming. Contrarian wise, this might be a time to look into energy. Yes, many are bearish on energy, saying global slowdown, this glut of oil, we really have supply demand, way more supply than demand. China is still extremely, struggling with its economy. Their like housing sector has been crushed. So oil really doesn't have a bid as a result. But if this is a cup and handle from 94 down to 82 back to 94, that's a 12-point interval of difference. At the 12 to 94, that's a 106. That's a measured target on XLE if we do get the breakout above 94. Two reasons. Geopolitical crisis, maybe if it's something really bad, where if Israel decides to attack the Iranian oil fields, that's going to cause a big, decent spike in oil. And that could cause the XLE to shoot up. That's one possibility. The other possibility is this has been more of a Trump trade, by the way. Trump is a big believer in US oil, basically pumping like no tomorrow. And hence the market thinks that if Trump's going to win, that's pretty much a Trump trade move. Oil prices are going to be depressed. They're going to stay, a flush. US will have a lot of capacity of oil coming in the market. And hence, from a supply demand issue, oil prices would not go up too much. What if that's not the case? We know it's a very tight contest. Maybe Harris wins and Vice President Harris wins. And if that happens, oil prices could get a bid and could break out higher. So this is something to look at. And the other factor really is dollar. Oil and dollar are inversely correlated. Dollar right now is hitting a reasonable higher highs literally the last 3 weeks. UUP, the dollar ETF, is above 29.3 or somewhere around that level. So if dollar gets a pullback, then maybe oil gets a bid. That's the other thing to look at. Now, let's just shift gear and talk about this week's poster child, Tesla. They announced earnings. Dan Ives, the perma bull, he's bull on NVDA, he's bull on Tesla, he's bullish on Meta, he's just bullish on big tech, the Magnificent Seven stocks. He pounded the table saying, wow, did Elon Musk deliver an early Christmas present? He's extremely confident. He really was thrilled about the gross margins. Tesla's gross margins, because of pricing pressure out of China, they've been cutting prices on their models, had come down to 15%, the gross margin, from above 20% a couple of years back. That 15% margin was again an expectation for this quarter that Tesla blew away. From 15% as market expected, Tesla announced 17% gross margin. And that's without the just on the auto manufacturing cost. But if you take the subsidies, that margin was closer to the 19%, 18.8 or so. Musk promised that margin exceeding 20%, back to the 20% level. He's got the automation into the factories. He's quite confident. He's just ruled out the Model 2, but he still thinks that a Model 3, getting that price below 30,000 is a possibility by mid of next year. And further, he was very bullish, talking about 20 to 30% car volume growth. Right now, we know that we have anywhere from, he had a 430 or 440,000 cars that were in this quarter, roughly around the run rate is around 1.8 million. He expects to cross the 2 million mark for sure next year. Of course, he said subject to geopolitical conditions, presidential choices and all that, but he seems very bullish on Tesla's outlook next year. So that said, what does the chart of Tesla tell us? Interesting enough, we had written a blog about this. We had written this before the big cyber robotaxi event that happened in Hollywood. We had said that this could potentially be an inverse head and shoulder. It is a beautiful inverse head and shoulder. The neckline is on 265, 270. Left shoulder is on 191. The head at 138.8 or 139. Right shoulder at 182. That break above 265 measures to 403. Turned out bears pounded the stock down after the robotaxi event. Didn't quite like it. But look at this week. Earnings were strong. Very, very bullish, 25% right there, 22%. But if you look at from the lows from where it came back higher, beautiful engulfing, bullish engulfing candle right here. Why is it bullish engulfing? This candle started off at the low, ended at the high of the week. The entire range took over the last 3 weeks of trading. Last 3 or 4 weeks of trading's range is covered by this single candle alone. That's why it's engulfing. Bullish because it's pointing higher with decent volume. This effectively is gearing up for a major breakout of 270. We know he's been actively campaigning for Trump. If there's a Trump win, the possibility this stock gets a massive breakout. And he is being touted to manage the Department of Efficiency, as he calls it. That said and done, his dynamics on his company, its fundamentals, and being able to bring gross margin higher, cut costs down, bring in automation, AI. And as Dan Ives has said, this is one of the most, like, call it underplayed AI company. It is a true AI company. It's at the end, the driving automation is all through AI, but people are not recognizing its AI potential, according to Dan Ives, and this says significant. Now, Dan Ives' target is not too far from where it is right now. It closed near 270. Dan Ives' target is 300 on Tesla, and his bullish target is 350. But the technical pattern, why is it 403? 139 to 271. Just take that. 139 to 271. You're talking about 132 is the difference between 271 and 139. Add 132 to 271, right? You get 403. That's why we feel that this beautiful inverse head and shoulder. The only red flag is AD has been declining steadily over the last year and a half. AD as an accumulation. So money from smart money has not quite accumulated on the stock as much. But look at the climb in this part of September, October. It is now turned around, begun to climb. RSI is, tested the 50 level, which is the neutral range, and now begun to climb. PPO is above the zero line and begun to climb. Alignment is all there. And with this bullish engulfing candle we got this week, I would not be surprised to see Tesla break out 270 and make around to 403. That's going to make it back into the $1 trillion club and give it higher highs. Now, one stock that got hit, also a story stock, pretty much correlated inversely with Tesla because of Tesla coming at their business with the car hailing service, right? The robotaxis at the end would be driverless, would effectively, Tesla would run the service. They would have the cars, they would run the service. And that could potentially impact Uber's business. Why Uber got hit. Uber had a beautiful cup and handle from 75 to 55. That's a 20-point level. Add that to 75, closer to 94, 95 is the target on that cup and handle. It didn't quite get there. It got to 87, close enough. But then RSI was strong. PPO was at a higher high, and then it pulled back. Pullback is not in as bad a volume. Notice the AD. AD had shot up in the October level to higher highs, higher than the previous AD levels. It is pulled back, but not pulled back to lower lows. It is hanging in there, is kind of, call it consolidation. Pull back to test the 20 rising 20-day moving average. 20 is above the 50, bullishly aligned moving averages. This could be a buying opportunity, in my opinion. You'll see what Uber does. Uber's momentum was strong, did quite well in the previous earnings in August. November, like the week after next, when they announce earnings, they may be reasonably strong, and we could see Uber break out back above to test its 95, 94 level. So that's something I'm bullish on Uber. What about Bitcoin? So switching gear from Tesla, Uber to crypto, another Trump play. Trump has been very bullish on crypto. He's talked about intervening if he is back as the president from the US Treasury into crypto quite actively. He's a firm believer in it. And look at the beautiful ascending triangle pattern. We've drawn this and shared in the blog in the past. We wrote a blog about this today as well. This measure target is 81, just near term. Why? Because you can see a flat kind of a resistance level at 66K level and rising lows from 49, 52, 58.9 broke out. Has not picked up strong momentum from the breakout where RSI shoots above 70 and PPO just keeps climbing. But look at AD. That's the leading indicator. AD shows smart money is expecting this breakout. And in fact, this is just a daily chart. But what we shared today was the weekly chart. And if you look at the weekly chart, I think it's right here, it's a bull flag. That's the flagpole from around 15K to 74K. Then flag with the declining trend here of the highs and the lows, and it broke higher. It, however, just dipped back below the top trend line. But this measure target is over 100K, 120, 130K. So six figures is coming in crypto. And if there's a Trump win, look at the PPO. PPO histogram, there's a crossover, a bullish crossover. Histogram went positive. this week. AD is climbing higher highs. All of this indicates that this is a possibility that we got a bullish bull flag consolidation, a nice pull from 15K to 74, consolidation over the next, I don't know, say 8 to 10 months, now ready for a breakout. And six figures could be quite possible next month. By November, we could see that. Finally, I talked about a stock that I've been following on the very well-known speaker, audio speaker space called Sonos. This has an ascending triangle pattern. They had kind of a situation in the May timeframe when their app that came out didn't quite do well, steadily trending down lower. However, their August earnings was decent. Their margins were strong at 48% or so gross margins. It recovered from the low close towards the highs of the day that day. And this is got a nice ascending triangle with the resistance at 13, base near 10. That's the 3 point to 13 is 16. That's the measured target on it. Love the strong accumulation. Another leading sign of this breakout potentially coming. And I just said that, and also look at the bullish cross. The 20 has a silver cross above the 50. 50 is in blue, 20 is in red. 20 is crossed above the 50, climbing. 20 is already climbing. 50 is basing and about to climb. A bullish recovery trend could be starting from here, which means a move to 16. And potentially, if you can take out 16 to back to 22, is where Sonos could be headed. Something to look into. It's a small cap. It's only 1.5 billion market cap. Selling at a price over sales of 1. The revenue is around 1.5. No debt. Strong balance sheet, around 270 or 280 million cash in the balance sheet. Something to look at. With that, good luck trading. We've got next week deluge of tech earnings. All the big magnificent 7 tech earnings will be there. The $1 trillion club stocks call it. And we know that we're getting closer to the election every day. We are now 7 trading days from the election. And we'll see what the market does. Will we get a 5 to 10% pullback ahead of the election, or will that be postponed till the decision night on the November 5th and November 6th? We see the big movement. That week, 2 things. There is, of course, the outcome of the election just a couple of days after that. So that's 5th Tuesday. Tuesday night, we'll know the election results. Hopefully, it'll be resolved and not be hanging out there. That's going to be a big market setback if it turns out to be an undecided situation where they need to recount and they need to just prolong the decision on the winner. And that Thursday is FOMC's decision, that next rate cut that the market thinks will be 25 basis point. Will they do a 25 or they will do another 50? They are going to be, of course, watching the whole election outcome situation. Any market volatility coming out of it, they may intervene and do a 50. We'll see. So with that, happy trading. Good luck, everyone. And we'll talk to you next week.